In summary, an LLC is the most flexible legal structure because you can have it taxed like an S corporation, C corporation, partnership, or sole proprietorship. However, it's not a silver bullet because some professions don't allow LLCs, especially in California. Despite this, most small business owners, from a tax perspective, opt to be treated as an S corporation due to the FICA tax mitigation, whereas most real estate owners choose to be taxed as a partnership because of the flexibility of basis adjustments and because rental income itself isn't subject to any FICA taxes. When selecting the right entity for your business or rental activity, it's crucial to consider legal and tax attributes as well as your long-term and short-term goals. When determining the best entity for your business, we must consider two sets of attributes, legal and tax. From a legal perspective, you have the option of not setting up an entity and being treated as a sole proprietorship or partnership if there's more than one person involved. You can also choose to set up a limited liability company or a corporation. Professional corporations are suitable for professions that need to clearly indicate their profession, such as doctors or CPAs. Additionally, there are less common entities that are used in special circumstances. From a tax perspective, you have the options of being treated as a sole proprietorship if you're opening a business by yourself, or a partnership if you're working with others. Your second option is a C corporation, and your third is an S corporation. Similar to the legal perspective, there are other specialty type structures meant for very special situations. Let's delve into some of the legal attributes of the most common entities. The three most common entities are sole proprietorships or partnerships, limited liability companies, and corporations. A sole proprietorship or a partnership requires no formal agreement or formation. As a sole proprietor, you simply start doing business, and in a partnership, you can begin with a handshake agreement. This structure offers no liability protection, although some opt for fictitious business names or DBAs or formal partnership agreements, but the structure itself provides no liability protection. Now let's discuss limited liability companies. These are formed under state law and are unincorporated businesses. They can offer liability protection, especially to limited or non-manager members. Finally, there are corporations. These are incorporated entities under state law and can offer liability protection. However, corporations are extremely formal, requiring minutes and bylaws. Additionally, if you're a professional, you may need to incorporate as a professional corporation and include the profession in the articles of incorporation. That being said, this is not legal advice, so please consult an attorney. Once you've chosen your legal entity, the next step is to decide on the tax treatment. If you opt for a sole proprietorship or a partnership, you must file accordingly. Now, if you choose a limited liability company and you're the sole owner, you'll default to be treated as a disregarded entity, taxed as a sole proprietorship. And if there's more than one owner, you'll default to being taxed as a partnership for tax purposes. However, as an LLC, you can elect to be treated as an S corporation or a C corporation. And if you decided to become a corporation, by default, you're going to be considered a C corporation, but you can also elect to be treated as an S corporation. Regardless of what structure you opt for, you're allowed similar tax deductions so long as they're ordinary and necessary to your business. The key differences come from the following topics: who is allowed to own each entity, classes of owners and whether or not they have to take pro rata distributions, how debt is treated for at-risk purposes, how outside versus inside basis is treated, how the disposition or distribution of assets are treated, and what the filing requirements are, how FICA taxes are levied, and FICA taxes stand for Federal Insurance Compensation Act, and that's the law that created Social Security and Medicare tax, sometimes referred to as self-employment tax when you're a sole prop, or referred to as payroll tax when you have employees. Whether you pay the brunt of the income, the next topic is whether you pay the brunt of the income tax at the entity does, and finally, how distributions to owners are treated. I will describe each of these at a high level in the next few slides, and for each topic, I will decide a winner. So who can own each of these entities? Well, a sole proprietorship is just an individual, and a partnership can be owned by almost any individual or entity. S corporations have more stringent requirements, such as not allowing non-resident alien shareholders. Otherwise, eligible shareholders do include individuals and certain trusts, estates, or special entities. Additionally, S corporations must have fewer than 100 shareholders. As for C corporations, they can be owned by almost any entity or individual. That's why most of your public companies are C corporations. It's also important to note that rollovers as business startup, or ROBS 401k for short, which involves financing a small business with your 401k, can only be done in a C Corp structure. The winner here is going to be C corporations. When we're discussing the classes of owners, it refers to the rights owners have to distributions, votings, and any other rights they possess in connection with their ownership. In a partnership, profits, losses, and capital interests are allocated per the partnership or operating agreement. And these allocations can be independent of each other as long as they have economic substance. In the case of an S corporation, only one class of stock is allowed. This means that all owners must receive distributions in proportion to their ownership percentage. Lastly, C corporations are permitted multiple classes of stock, including common stock, preferred stock, and various class distinctions, like Class A or Class B shares. The winner here is a partnership structure because it has the most flexibility. But be careful, because flexibility can sometimes become an accounting nightmare. At-risk limitations apply when you attempt to take losses from pass-through entity on your individual tax return. The at-risk amount represents the money you've invested that you stand to lose. In a sole proprietorship or a partnership, debt from third parties can be at risk to you as the owner if you're personally liable for that debt. Additionally, partnerships allow for non-recourse financing, which are also considered at risk. Non-recourse financing refers to financing secured by real estate, known as mortgages usually. On the other hand, S corporations recognize only capital contributions and loans from shareholders as at-risk capital. This severely limits your ability to take losses during the startup phase of a business where you might be using debt to cash flow the business. Partnerships win this round. Outside and inside basis can differ significantly as owners join or leave while the business operates. In a partnership, a Section 754 basis adjustment helps align the outside and inside basis for a specific member. Let's consider a scenario with a three-partner entity. They buy a property for $600,000, and this property then appreciates to $900,000. Then one partner decides to exit, selling their share to someone we'll call Party D. Party D now prefers to take depreciation on their shared asset on a $300,000 valuation, right? Because now the property is worth $900,000 and they're owning 1/3 of that, rather than using the departing partner's adjusted basis. Section 754 steps in here, allowing a basis reconciliation. This enables Party D to depreciate their portion of the property starting at the $300,000 valuation. In a corporate structure, unlike with partnerships, There is no mechanism to adjust and reconcile the difference between the outside and inside basis. Party D would have to wait until selling their interest to another party to recover that basis. And that goes both for S corporations and for C corporations. Occasionally, you may wish to distribute assets from a business entity. For partnerships, you can remove an asset and its basis just carries over to the owner removing that asset. This doesn't lead to a taxable event unless it's considered a disguised sale. Essentially, you can contribute something to a partnership and withdraw it at the adjusted basis without incurring any tax. In contrast, with a corporate structure, distributing assets is treated as a sale at fair market value, leading to a taxable event. And the only way around that is through a qualified reorganization, which is highly complex. Therefore, partnerships win this round. For tax filing, a sole proprietorship is considered a disregarded entity, so it files a tax return on the individual's owner's return. However, in California, if the sole proprietorship is structured as an LLC, it is required to file Form 568. And this is true for most states. If you have an LLC, you might still have to file a state tax return for the entity. Partnerships file their own tax return using Form 1065. They then issue a K-1 to transfer the taxable attributes from the entity level to the individual partners. S corporations file their own tax return on Form 1120S, and like partnerships, issue K-1s to pass taxable attributes to their shareholders. C corporations file their own tax return using Form 1120 and do not issue K-1s to their shareholders. Sole props win this round because of the lower tax prep fees, though some would argue they reduce the liability protection to the owner, even if they're an LLC. FICA stands for the Federal Insurance Contributions Act. FICA is the law that established Social Security and Medicare taxes. For sole proprietorships or partnerships, all income earned by active partners or members is subject to FICA taxes. S corporations don't pay FICA taxes on their profits. However, they must meet the reasonable compensation requirement. FICA taxes are applied to the wages paid to employees, including shareholders, through the W-2 form that actually meets this requirement. C corporations pay income tax at the entity level, making FICA taxes irrelevant for the owners in that context. However, again, they are responsible for paying FICA taxes on the payroll for all of their employees. S corporations are better here because you greatly reduce the amount of FICA taxes you pay. And this is the main reason that most small business owners use the S corporation. For tax filing, a sole proprietorship is considered a disregarded entity, so it files a tax return on the individual's owner's return. However, in California, if the sole proprietorship is structured as an LLC, it is required to file Form 568. And this is true for most states. If you have an LLC, you might still have to file a state tax return for the entity. Partnerships file their own tax return using Form 1065. They then issue a K-1 to transfer the taxable attributes from the entity level to the individual partners. S corporations file their own tax return on Form 1120S, and like partnerships, issue K-1s to pass taxable attributes to their shareholders. C corporations file their own tax return using Form 1120 and do not issue K-1s to their shareholders. Sole props win this round because of the lower tax prep fees, though some would argue they reduce the liability protection to the owner, even if they're an LLC. Our closing subject is on taxation and rates. Sole proprietorships, partnerships, and S corporations are pass-through entities. This means that owners pay taxes at their individual rates, which vary from anywhere from 10 to 37%. They owe taxes on the business earnings even if they don't distribute the cash. C corporations pay taxes at the entity level, facing a flat federal tax rate of 21%, and in California, 8.84% under the current legislation. However, if a C corporation distributes dividends, the shareholder must pay income tax on those dividends. This can lead to double taxation, where earnings are taxed first at the corporate level and then again at the individual level on those dividends. There is no clear winner here because it really depends on how profitable the business is and whether you'd like to take the cash out of the business or the cash needs to remain in the business to, finance the purchase of inventory or future business developments. In summary, an LLC is the most flexible legal structure because you can have it taxed like an S corporation, C corporation, partnership, or sole proprietorship. However, it's not a silver bullet because some professions don't allow LLCs, especially in California. Despite this, most small business owners, from a tax perspective, opt to be treated as an S corporation due to the FICA tax mitigation, whereas most real estate owners choose to be taxed as a partnership because of the flexibility of basis adjustments and because rental income itself isn't subject to any FICA taxes. When selecting the right entity for your business or rental activity, it's crucial to consider legal and tax attributes as well as your long-term and short-term goals. This presentation was created to support our comprehensive tax planning service, where we curate strategies to assist taxpayers in reducing their tax liability. We do this by analyzing their business, real estate, and individual activities and determining the optimal structure, optimal accounting method, available tax deductions, and available tax credits. Then we prepare a summary of estimated tax savings and effect on global cash flow to assist our clients in determining which strategies to pursue. Finally, we coordinate the action items needed to actually achieve these savings. If you're interested in learning more, please schedule a call with us. Current clients, please reach out to your partner or accountant, and all others can call our office to schedule an intro call.